So I'm going to take you through, I'm going to spend most of my time talking about giveaways to savers, but also a few other changes to the personal tax and benefit system that were announced yesterday. Let me start with excise duties. So Kate has talked about the new tax on sugary drinks. Taxes on alcoholic drinks were reduced yesterday, with duties on spirits, beer and cider all frozen at a cost of £85 million a year. Much bigger in revenue terms, though, was the Chancellor's decision at a cost of over £400 million a year to freeze fuel duty again. That brings the total real terms reduction since 2010 to 14% at a cost of over £4 billion. Now, if that means that fuel duties are at their lowest level in real terms since 1995, and the real cost of motoring at its lowest level since at least then. If duties can't keep pace with inflation in current circumstances, it's hard to see quite when it will. And Paul mentioned some of the questions that this raises for long-term policy dealing with the costs of motoring. If fuel duty freezes sound familiar, there was more familiar news of an increase in the income tax personal allowance, an additional increase over and above the above-inflation increase that we were already expecting for the next couple of years. That is a giveaway of £2.5 billion on top of the £15 billion given away through changes to the personal allowance and higher rate threshold during Mr. Osborne's previous budgets. Now that is, of course, a giveaway to basic and higher rate taxpayers. It is increasingly worth remembering that now a very large fraction, 43% of the adult population, do not have incomes high enough to pay income tax at all. So this is very much a giveaway to the better off parts of society. To reach the Conservatives' manifesto targets of £12,500 and £50,000 respectively by 2020 would cost another £3 billion or so. So to show put this in context for what's happened, particular to the number of higher rate taxpayers, the number of higher and additional rate taxpayers has increased from 1.7 million at the start of the 1990s to around 5 million now. The effect of yesterday's reform was essentially to prevent a further increase of 400,000, keep the number roughly where it is now for the next couple of years, but that still means that there are 1.8 million more higher rate taxpayers than there would have been without any discretionary reforms since 2010. So let me move on to those big savings tax reforms, and the first one was a reduction in capital gains tax rates. Now, the first thing to point out with capital gains tax is always a reminder that capital gains tax is levied on the increase in value of assets from when they're bought to when they're sold, but does not apply to people's main homes, to their pensions or to their ISAs, which is where the vast majority, over 80% of people's savings are held. And also that the first £11,100 a year of capital gains realisations are entirely free from tax as well. So this is only applying to a relatively small number of generally pretty well-off people. So for those people, if they're basic rate taxpayers, the CGT rate is currently 18%, except for assets, broadly speaking, owner-managed businesses that qualify for entrepreneurs' relief, and those are taxed at a reduced rate of 10%. For higher rate taxpayers, entrepreneurs' relief still leaves it at 10%, but the main rate is 28%. What was announced yesterday? Well, the rate for most assets was reduced by 8 percentage points, so from 18% to 10% for basic rate taxpayer, but with exceptions for housing and also for carried interest received by private equity investors, and entrepreneurs' relief was unaffected at 10%. Similarly, for higher rate taxpayers, we get the same 8 percentage point reduction for what I've labelled here as other assets, the qualifying assets, which are mainly shares, but also some other financial assets, physical assets, second and subsequent homes, and so on. Now, in terms of what this does to the incentives and efficiency in the system, if we think just first of all about those qualifying assets where the rate has been cut by 8 percentage points, there's clearly a positive aspect to that. That's reducing the disincentive to save and invest that capital gains tax generally creates. The downside, of course, is that you're foregoing revenue from those savings and investments that would have happened anyway, which we might think we can tax heavily if they would yield high enough returns to be worthwhile even in the presence of taxation. And also creates some incentive to, well, strengthens the incentive for people to convert income into capital gains as a way of avoiding tax, although some of the assets which provide most scope for doing that weren't affected by this reduction yesterday. In addition to that, because as we can see this is a reduction for some assets rather than others, this does a mixture of things in terms of creating or increasing tax biases for one asset over another, while reducing corresponding tax biases in other areas, so the discrepancy between entrepreneurs' relief and arm's length shareholdings, for example. So there are some areas where this looks like it's an improvement in efficiency, some where look like it may make the system less efficient. What I think is clearer is the way that tax policy has been made in this. It was only in 2010 that Mr. Osborne himself increased the CGT rate for higher rate taxpayers from 18 to 28%. So reducing it again to 20% looks like an almost complete reversal of that policy. Now, Mr. Osborne is not alone in doing this. For decades now, UK chancellors have followed a kind of yo-yo pattern with capital gains tax rates as they've gone up or down every few years, and as preferential treatment for certain types of assets or assets held for certain periods has been introduced and then removed again. Clearly that kind of uncertainty is not helpful for people making long-term saving and investment decisions. And I think the continuing fluctuation of policy essentially reflects a long-standing underlying tension between, on the one hand, a desire to minimise disincentives to save and invest and therefore have a low tax rate, but on the other hand, to have the tax rate as close as you can to tax rates on ordinary income to minimise opportunities for avoidance. Now, there is a fundamental underlying tension there, but what that demands is a strategic look at what the role of capital gains tax is, how it fits into a broader system for taxing savings. And we haven't really seen that from any government. For what it's worth, we proposed our own preferred solution to this. We think you can more or less have your cake and eat it on this particular conundrum a few years ago, and I will be happy to talk in exhausting length to anyone who wants to about how you can do that. So the second substantial change on savings taxation announced yesterday was a big increase in the limits on saving in an ISA. So this shows you the limits on ISA saving and pension saving over the last few years. And what's striking taking these together is while we've seen a significant increase in ISA limits, perhaps, almost a trebling despite the scale on the vertical axis, there's been a big reduction at the same time in the amount you can put into a pension. So a few years ago, the amount that you could save in a pension in any 1 year was more than 30 times the amount you could put into an ISA. After this reform is introduced, it will be exactly twice, 40,000 rather than 20,000. And that's a really big shift in the pattern of what kinds of tax-free or tax-privileged saving the government is allowing and encouraging. More noticeably, the Chancellor also announced an entirely new kind of ISA being introduced, the so-called lifetime ISA. This is actually quite similar to a proposal the Conservatives made in their 2005 election manifesto. So how will it work? Essentially, people aged between 18 and 40 will be able to open one of these accounts. Contributions to it will count towards their ISA limit. It'll look like ISAs, like an ordinary ISA in many respects, except that the government will add 25% to the first £4,000 a year of contributions that you make to this account. So if you do this every year, you're allowed 32 years from age 18 to age 50, you can get a maximum top-up from the government of £32,000 in return for a contribution of £128,000 that you make yourself. What happens to this money? Well, once you hit age 60, you can withdraw it freely and do what you like with it. If you want to get at it before age 60, you can use it to buy a first home if that costs less than £450,000. There are some important details the government has announced and in some cases is consulting on about how easy it'll make it for people to be able to take money out and perhaps put it back earlier than that for other purposes. So how does this incentive to save compare to others that we see in the tax system? So what I'm going to show you is how much you would have to save in a variety of assets to end up with the same wealth as you would get from saving £100 in an ISA or generally a kind of plain vanilla tax-free savings product. So essentially, the lower the number here, the stronger the incentive to save. So for an ISA, this number is 100 by definition. For the new lifetime ISA, that's going to be 80. So if you put £80 into it, the government will add 25% of that, £20 to that, and otherwise it will look exactly the same as an ISA. So if you're happy to tie up your money until you're 60 or buy your first house with it, saving in a lifetime ISA looks like a clearly preferable option to saving in an ordinary ISA. What about putting money into a pension? Well, for that, the incentive to save depends on the tax band you're in, both at the time that you're putting money into the pension and then at the time that you're withdrawing it in retirement. So if you're a basic rate taxpayer throughout life, you have a slightly stronger incentive to save in a pension than you do in an ISA. That's essentially because of the 25% tax-free lump sum that you can take. But clearly the new lifetime ISA looks like a much better bet. If you're a higher rate taxpayer throughout your life, then the same is true, although to a lesser extent. But particularly because of the reductions to the amount that you can save in a pension that I was talking about earlier, in future it's actually going to be really quite hard to be a higher rate taxpayer in retirement. Most people who are higher rate taxpayers when they're working and saving will be basic rate taxpayers in retirement. And for those people, because with a pension you get, these people will get 40% income tax relief on the pension contribution, but only pay 20% income tax on the pension income, in addition to getting 25% of it tax-free, saving in a pension will still look like a better bet than saving in the new lifetime ISA. Similarly, around half of basic rate tax-paying savers won't be taxpayers at all in retirement, and for them, in tax terms at least, pensions and the new lifetime ISA look pretty much exactly the same. So I think two further things to be said about this. First is that I've been talking here about an employee making a contribution to the pension. If you can persuade your employer to do it as well, and perhaps reduce your salary in return, that is still a more tax-favoured option than any of the ones that I've considered here. Second thing is that I've been presenting this as if saving in a lifetime ISA and saving in a pension are alternatives to each other. But actually what you can do is put your money into a lifetime ISA, and then when you hit 60, up to the limits that are prescribed, gradually transfer it into a pension so that you then get both a top-up into the lifetime ISA and a 25% tax-free lump sum available from your pension. Now, again, there are limits to how much you can transfer into a pension in different circumstances, but insofar as you can, again, that looks like an extremely favourable option that's being created. So what do we think of this policy? Well, there are long-established rationales for encouraging people to save for retirement, though how strong they are and what magnitude of encouragement they justify is more debatable. It's less clear what the rationale is for encouraging people to save for a home rather than for anything else they might want to spend their money on before retirement. And the OBR expects that this will increase demand for housing and therefore bump up house prices a little bit more. We would expect quite a lot of the money that goes into this to be shifted in from existing savings vehicles. So just to give one rough idea of magnitude, the latest data that HMRC publishes, there are over 3 million people under the age of 45 who had more than £3,000 in ISAs alone that they could shift into this new vehicle to get a top-up, rather than the effect purely being to encourage new saving that wouldn't otherwise have happened. So the big winners from this policy are essentially basic rate taxpayers who are in a position to transfer in existing savings without even necessarily having to do more saving than they otherwise would have done. Sadly, in its analysis of this policy, the government has actually published rather little detail of what it expects to happen. The wording in the documentation implies that they have a view as to what the long-term cost of this policy will be, how many people will take it up, how much of what goes in will be new savings versus coming from other existing saving vehicles, but it hasn't seen fit to tell us what it is forecasting or assuming about any of those things. And depending on the answers to those, this could potentially be a very expensive policy. As had been, as they'd said a couple of days earlier, the government also announced a second, actually rather similar policy available from 2018 for people in families, essentially working families receiving means-tested support, universal credit or working tax credit. They'll be able to pay £50 a month into a new Help to Save vehicle, and the government will top that up, not just at 25%, but this time at 50% after 2 years, and then we'll do the same after another 2 years of contributions. So if you contribute the full £50 a month for 4 years, you can get a top-up from the government of £1,200 on that. And about 3.5 million people will be eligible for this once universal credit is in place. Now, the government's stated rationale for this is that some low-income families may be under-saving, and particularly may be lacking a rainy day kind of fund that they can draw on if they need. And that is undoubtedly true, but we should also remember that there are plenty of families who are currently on receiving means-tested benefits or tax credits who do save or have existing savings. So of those who will be eligible for this subsidy, we reckon that over half of them will either already own their own home, which perhaps means they can get access to credit more easily, or already have more than £1,500 of financial assets, or already be saving more than £10 a month. And of the remainder, at least some might be quite sensible for them not to be saving, particularly if this is just an unusually low income period and they expect to have higher income in future, or if the rainy day arises, they could borrow at a relatively low cost. So I think the key question for this policy is whether those people who take advantage of Help to Save will be the same people, and there are undoubtedly some people who are under-saving at the moment. And the danger is clearly that those people who take advantage of the policy will be those who have savings, would have saved anyway, and can transfer money in relatively easily to take advantage of this, whereas those who can't save but perhaps ought to be won't be able to save in response to this policy, just won't have the disposable cash, or may not even be aware of it and the advantages it brings. And we have some evidence on this, because the Help to Save policy is remarkably similar to the Saving Gateway policy that the last Labour government piloted, and IFS researchers and colleagues in the audience were involved in, and on the stage, were involved in evaluating those pilots. Now, when it was due to be rolled out shortly after the general election, Mr. Osborne cancelled it because it was not affordable given the need to reduce the deficit, and a need which is apparently no longer so pressing. So what did we say at the time? Well, handily, this was what we put on our website. I think that headline pretty much speaks for itself. You may not be able to see the print, but if I can just read out one sentence, it says, the IFS evaluation of this scheme found no evidence of an increase in overall savings and limited evidence of account holders reducing their spending. Suggests that some of the dangers I was talking about may apply in this case too. Finally, there was one big change to benefit policy that was confirmed in yesterday's budget, a cut to the personal independence payment, which will impose losses that are really quite big, £3,500 on average for the 370,000 claimants who will lose from this. Now, that's a fairly big reduction in this benefit, but this is the reduction in spending is actually smaller than the increase in spending that's just a forecast revision since last November. And this is the latest in a long line of upward revisions by the OBR. So this is what the OBR was expecting to happen to spending on DLA and PIP in March 2013. In a series of subsequent fiscal events, that has been steadily revised upwards. And in yesterday's budget, even without the new announcement, there would have been a further big upward revision to how much the government could expect to spend on disability benefits. And so yesterday's announcement of a cut is actually only going part of the way to reversing to offsetting the increase in the forecasting increase for a given policy. And to put this in a longer-term context, we should also remember that spending on these benefits has almost quadrupled over a 20-year or so period in real terms. So, to summarise, winners from this budget include alcohol drinkers, drivers, income tax payers, and a lot of savers. Losers include what I'm going to persist in calling sugary drinkers and some recipients of disability benefits. Various familiar themes from Mr. Osborne's stewardship of the public finances have recurred: increase in personal allowance, reduction in fuel duties, cuts to benefits, more tax privilege savings options outside pensions, and more stoking up of the housing market. There was a change of direction on capital gains tax rates, but in some way the change of direction in itself seems to be a familiar theme with capital gains tax. Clearly the biggest, most fundamental changes are to the treatment of savings, but we should be aware with all of the reforms that I've discussed that a lot of their effect might be to give giveaways to existing savers for savings they'd already done or would have done anyway, rather than necessarily generating a lot of new savings. I'll stop there.